Hello, students. It's nice to have you back to school. On this note, I say welcome back to school. In this lesson, I'll be teaching trading profit and loss account. Trading profit and loss account. Each organization or business intends to make profit, which is solely the aim of going into that business. All right? Every company you see out there, institution, intends to make profit in the business. All right? And then there are certain terms you're going to see in this topic, like stock. Stock refers to the goods. An opening stock refers to the goods you have in your organization at the beginning of the business. And then you have purchase. Purchase refers to the goods you bought to add to the opening stock and the rest. Now, what is trading profit and loss account? Trading profit and loss account is calculated once in a financial year to enable the organization know if they are making profit or loss. Okay? Now, let's look at the purpose of trading profit and loss account. The purpose first is to show whether a business has made a profit or loss over a financial year. Secondly, to determine how that profit or loss arose. All right? So this will take us to trading account proper. Remember, you begin this account first by calculating the trading account. In other words, trading account is calculated to determine the gross profit or gross loss of an organization. Now, what is gross profit? Gross profit is the excess of sales over cost of goods sold. In other words, is it calculated sales minus cost of goods sold. Here is the example of gross profit, which is sales minus cost of goods sold. So you deduct the cost of goods sold from sales. Whatever value you have is referred to as the profit. So in this case, there is a profit. Loss is less than cost of goods sold. All right? Now, determination of business profit or loss. To achieve this, the value of purchases made during the year is added to the value of opening stock, and then closing stock is deducted to arrive at the cost of goods sold. And after that, you deduct the cost of goods sold from the sales to arrive at your gross profit. Here is the example of what I just said. Now, you begin with the opening stock and then you add your purchase. Whatever value you got is referred to as cost of goods available for sales, and then you deduct the closing stock. After deducting the closing stock, you have a value, and that value is referred to as cost of goods sold. All right? I hope you are following. And then let's look at the profit and loss account table. Remember, the left side is referred to as the debit side, and then the right side is referred to as the credit side. The rule states that, or the format states that operating expenses are to be debited and then revenues and incomes are to be credited. All right, now trading account, do not forget I said is calculated first before the profit and loss account. And the trading account is calculated to enable the business determine their gross profit or gross loss. And when this is achieved, you move your gross profit to profit and loss table. Okay? And then you take it up from there. The rules for preparing profit and loss account states that the first thing first is credit the gross profit from trading account to it. The it here means your profit and loss account. Remember, I stated earlier that trading account is prepared first. And the second rule says credit all revenues from sales of goods or services. That is the income or gain you made. And then the third says debit gross loss from trading account, if any. The fourth rule says debit all operating expenses. All right? And the rest. Now, do not forget that we have the debit side, and this can be abbreviated like DR, and the abbreviation for credit is CR. In this format, the debit side is referred to as spending side and the credit side, the receiving side. That will be all for this class. I'll see you next class. Please, like I always say, stay safe.